Welcome to the second webinar of our new series. We did one 2 weeks ago. We've got another, we'll be rolling out six more in the first quarter and bringing you hopefully topics that are very helpful and thought-provoking. My name is Jim Teagarden. I'm the CEO of Impact Wealth. We have been in business for about 30 years, helping families, business owners, execs, high net worth folks lower taxes, reduce risks, and preserve and protect wealth for multiple generations. So we're going to be talking today about folks who maybe have met their goals for their lifestyle and are focused more about what can they do with excess capital for multiple generations, for charities, impacting the world with what they've been blessed with. So um, disclosures, of course, we are not tax advisors. We are wealth managers, investment representatives of Madison Avenue Securities. We are partners with Singe Advisory Group, a $4 billion RIA out of Florida. I am also a founding board member of the Ridgeback Group, a new financial services firm. Obviously, investments have risk. We are not giving investment advice here today. We're just talking about ideas, etc. So this webinar is designed for families who have moved really beyond accumulation for themselves, and the focus is on income durability throughout their lifetimes and their generation two and three, tax efficiency, multi-generational wealth transfer. When families reach 10 million or so of net worth, the planning conversation generally changes into or from are we going to be okay to how do we maximize and optimize for our excess capital for longevity and long-term impact. So what we've noticed over the decades of working with these high net worth families, clear patterns emerge. We've found that wealth that lasts across generations is designed. It's not accidental. There's lots of things that can avoid or keep us from preserving wealth. And for us, we're very passionate about private capital. So our clients have been blessed with, they've worked hard, they've saved, and they've been able to accumulate capital that, when structured intentionally, can support families for generations, businesses, business growth, sustain employees, partners, fund charitable goals. And this webinar really is about aligning financial strategy with long-term impact. So using that capital to accomplish more with what you've gotten. So this webinar is really designed for those families over 10 million in net worth. They're not necessary. You don't have to do these things, or they're not appropriate for everyone. But we're going to be talking about things that are fairly unique and advanced. And really, once our families are confident with their lifestyle being funded for life, uh, we then can deal with excess capital and how do we be flexible and strategic around that. We do find, and we'll talk about when I say G1 or Generation 1, that's the oldest generation. Generation 2 would be the next generation, Generation 3 beyond. But we do find that of taxes become one of the largest long-term risks. And estate planning really should become proactive, not reactive. Timing decisions matter more than investment selection a lot of time. And so that's really what we're going to be talking about today. Okay. We have this from a risk perspective. What we see is taxation, both income taxes, other types of taxes, estate and gift taxation are a really big threat towards long-term wealth. And another risk really is business succession done poorly or not at all. Inflation hasn't gone away, isn't going away. It erodes long-term wealth. We know that. That's why we invest to increase our purchasing power over and above inflation. Behavioral and market risks that erode wealth and income generation plans, et cetera. Early deaths, healthcare emergencies, cost, divorce creditors, those are all risks that we deal with on a daily basis. There's this phrase that says there is no retirement without retirement income. And most folks think when we say that, we're just talking with the folks in their 60s, 70s, and 80s about their retirement. But in this case, with higher net worth families, there's income generations or income generation needs at G1 level, G2 level, G3 level. And how do you really do plan out for that over time? So we're going to talk about really some things that are related to generation one, but have a big impact on generation two and generation three. And they're things that we have found folks are really not taking advantage of. Okay. So most of our high net worth families are really interested in converting taxable and tax deferred assets into tax free or tax advantage structures so that we can reduce lifetime tax drag um, and do it in a safer manner than maybe what they were doing. And I'll talk in general about asset recharacterization, one very key component, and where we spend a lot of our time is really for folks who have accumulated a lot of tax deferred assets. It is not uncommon for us to be working with a family generation one worth 15, 20, 30, 40 million, and they might have two, three, five, $10 million in tax deferred assets. And because they haven't, there aren't a lot of planning options around that, they haven't done anything. We would tell you that Roth conversions done immediately and the taxes due on those being paid out of outside assets or non-Roth assets is something that everyone should be taking advantage of that fits these net worth categories. Um, and we just did a sample 60-year-old couple, just $1 million. If they just did a straight Roth conversion today, paid the tax, and we went out 40 years. So we're assuming one of the spouses lived to age 90 and that the heirs inherit that Roth for another 10 years tax free. A $1 million Roth conversion today literally produces a $10 million advantage 40 years out. So you can extrapolate there. If you've got a 2 million or a 5 million or a $10 million qualified plan right now, it's hugely impactful. And especially if generation one doesn't need it or want it. And we've found that that Roth provides a lot of benefits from a pure investment standpoint, um, being able to put highly taxed assets into a tax-free bucket, um, high returning long-term growth, illiquid assets in Roths can be huge for long-term wealth transfer. The other thing we find is for those same clients, take someone in their 70s and they've got a couple $1 million in tax deferred assets. If they take advantage of what we call a qualified leverage strategy, which is a combination of a couple different planning techniques around life insurance, profit sharing plans, and Roth conversions, it is very simple to show a 2 to 3 times improvement in wealth transfer. So if you take two 72-year-olds and you go out to age 95, assuming one of them lives to 95, that by doing this strategy, apples to apples comparison, the heirs are going to get 2 to 2.5 to 3 times more assets upon generation one's deaths. And part of those assets are going to be tax free for another 10 years. So that strategy, even if you're in your 70s and 80s and you have large retirement plan assets, you ought to be looking at this. Of course, there are some other things that we utilize. We use leverage life insurance, especially on younger insured. So under age 60 is the sweet spot. And we can use bank leverage to amplify the tax-free returns of cash accumulation life insurance policies. And this particular strategy we utilize is called the Kaizen plan. And we use that as a Kaizen wealth transfer strategy whereby generation one in their 70s or 80s even are providing contributions to allow generation two, generation three even to take advantage of leveraged life insurance outside the taxable estates in ways that is hugely impactful. In fact, if they used their retirement plan dollars to fund this, it is extremely better than a Roth conversion even. So we spent a lot of time in that area. Our focus here, our typical client worth 15, 20, 50 million that are in their 70s or 80s are taking advantage of those, what we call our great wealth transfer strategies. Um, and I'm going to move in. This impacts generation one, two, three, and this is something that is the tangible property regulations are maybe the biggest hidden tax deduction opportunities available in today's world. And I'm just going to talk briefly about those. This is really for families who own a lot of real estate, and a lot is a pretty wide term. $1 million, 5 million, 50 million, 500 million of properties, whether that's multifamily, commercial, doesn't even residential. And I'm just going to kind of highlight what these are. And of course, if you are interested, let us know. By the way, I didn't say this. If you have questions, put them in the Q&A section, and we'll address those here at the end. But the Q&A section for questions. So tangible property regs. I'm going to talk about this. We call this a form of tax method changes. Most people are familiar, most real estate investors are familiar with the term cost segregation, which is simply the accelerated depreciation of a property that you own. The default method of accounting is straight line depreciation, but by employing cost segregation, you can accelerate depreciation and improve your cash flow. Cost segregation is optional. It is subject to recapture when you sell the property. And we don't focus on that, but we do find a lot of folks who didn't do cost seg or didn't do it properly. And so we'll help on that if we see the opportunity. But cost seg, since real estate owners are somewhat familiar with that, kind of leads us into the tangible property regulations, which are not widely known or understood. The TPR regs were passed by Congress in 2014. And they allow for some huge, really huge tax saving opportunities today. And in our estimation, they represent the most important change in tax law in the past 40 years, yet most people and their CPAs are completely unaware of them. The TPRs are actually mandatory and must be followed. We find that most people are not following the tangible property regulations. Okay. These TPR regs guidelines lay out which costs must be expensed and which ones must be capitalized. Overwhelmingly, we find that most people are depreciating costs that should have been expensed. And under these regulations, we can go back in time and identify costs that should have been expensed and bring them into the current year for one large tax deduction. This does not require the amending of prior returns. There's no cost for our TPR studies, and in our opinion, anyone with a lot of real estate should be taking a look at the TPRs. If you're not familiar with them, let us know. We partner with an outside engineering and CPA firm that has literally written the IRS training for CPAs for this, and we have a great partnership relationship. So let us know there if you have lots of property and you'd like to explore TPRs. All right, shifting gears here into estate planning. We say estate planning is a timing decision. The current lifetime exemption amounts, so the big, beautiful bill that was passed in July, the tax law changes, increased the lifetime exemption of the amounts that you can give to other people without paying estate tax to 15 million per person. If you're a married couple, that means you have a $30 million exemption. So technically, if your estate is worth less than 30 million and you die, there would be no estate tax federally. Now, many states do have state level inheritance and estate taxes. So depending upon the state you're in, that still may be an issue, even if you have large lifetime exemptions for federal. Um, we believe, not believe, we've seen that these exemption amounts are very unstable and politically sensitive. We don't know what the future holds, whether those exemption amounts may go down, whether they may go up. But we want to be proactive about utilizing them today if we can. And that involves, if we're going to move assets, how do we do that in a favorable jurisdiction with as much flexibility as possible, keeping assets outside the IRS's reach for gift, generation skipping, and estate taxes, but still allowing our clients to accomplish their goals. And those goals may change over time. So being flexible is the key in our opinion. Okay. So we're going to talk a little bit about basic strategies or some, I guess, even more advanced strategies around estate planning. Okay. And I will talk a little bit about the basics of gifting. And a lot of our audience probably knows some of this, but you know, kind of the basics are we can utilize the lifetime exemption either at death or during life to move assets to generation two, generation three beyond. Okay. We also currently, in the current year, lifetime exemption, or sorry, annual exclusion amounts that can be gifted without a gift tax return are 39,000 per person for a married couple. So that's 2025. That is indexed for inflation. Will go up a little bit next year. There's also something called a generation skipping exemption. The IRS wants to keep us or make sure that we are not moving assets from generation one to generation three without tax. Most practitioners, when it comes to estate planning, start with the fact that we should take a look at moving assets from generation one's estate in trust to generation two, three, or beyond. Okay. One of the primary methodologies for leveraging our exemption amounts is to put assets in a family limited partnership where we can get a discount on value for lack of marketability and lack of control of 20 to 40% discounts. That just allows us to move more with less exemption. If we're really trying to move assets, if we're worth $500 million and we've got to move a lot of assets, we'll typically combine those partnership strategies with a contribution to a grantor retained annuity trust or the sale of those partnership assets to intentionally defective trusts. That just gives us more leverage to get more assets out. Okay. So those are the basics of where we start today. In general, with basic discounting, if you utilize your $30 million exemption and you get some discounts, a $50 million estate shouldn't have an estate tax. Now, that does not count for future growth. If you live another 20 years and your estate grows to 200 million, you still have an estate problem. So we have found a lot of folks in their 80s and 90s now that the exemption amount has passed. They know that they have an immediate estate tax problem should they pass away. Okay. And they don't have a lot of time and energy. They maybe already used their exemption amounts. They're in the gift tax regime right now on any future gifts. We have been utilizing for many years a term we call intergenerational split dollar, multi-generational split dollar life insurance, that we can move assets immediately or very quickly on folks who maybe are uninsurable, maybe they're don't have a very long life expectancy, and they really need to move assets quickly. As an example, we had a 93-year-old widow, and we showed just $10 million that if not moved today, we showed the family what generation four, so we're going down to the great grandkids' deaths, what they would inherit under the status quo. Okay. And That $10 million today, subject to estate tax upon mom's death, Generation Two's death, and Generation Three's death, would amount to $20 million to Generation Four. If Generation One takes advantage of our generational split dollar today, it's fairly easy to, not easy to understand, but fairly easy to implement. 200 million is what would go to Generation Four instead of 20 million, a 10 times improvement. So if you find yourselves or know of folks that are older that are in the gift tax regime right now, they ought to be taking a look at generational split dollar. We'd love to help them with that. The other thing, we touched on this earlier, leveraged life insurance, and this is really for people under age 65 for the most part, at least for us. We can utilize bank-funded life insurance or bank supplemented life insurance to buy very large life insurance policies in trusts that are not subject to the IRS from a gift or estate tax perspective. And that has a huge advantage over buying life insurance with your own dollars or not doing anything and paying estate tax. Okay. And so an example that we just did is a 55-year-old couple. They were looking at a need for $10 million of estate liquidity to pay taxes. Okay. And if they do nothing, the family will spend $10 million. They will have to liquidate assets to come up with $10 million to pay the tax. So the family understood that. We walked through what it would cost to buy life insurance, put it outside the taxable estate, and they would have to spend about $2.5 million or so over their lifetimes to buy 10 million of life insurance. They liked that strategy. It had very good economics, but we showed them how to use leverage life insurance in combination with their contributions. And instead of spending 2.5 to 3 million, they will spend about 800,000. So a significant reduction in their out-of-pocket gifted cash. They would have to pledge collateral of about $700,000 for about 10 years. Excuse me. But the impact to that is mighty. And so if you're younger, if you're concerned about long-term liquidity, you don't want to move a lot of assets. You want to have maximum flexibility for the future in changing your mind. That leveraged life insurance is something that we would assume, or we would recommend you take a look at. I'll hit on the estate planning piece again for the tangible property regulations. One of the things that if Generation One takes advantage of let's say a $5 million deduction today, and let's assume they didn't uncover that and they died with that assets in their estate, their heirs will receive a stepped up basis on those real estate assets. However, the heirs now cannot take advantage of the tangible property regs and get those big income tax deductions. And so the point being, if Generation One has large assets in real estate and they could take advantage of the TPRs, do it today. There's really some reasons why you want to take a hard look at that today. And that impacts multiple generations, obviously, if we can save money today versus not being able to do it in the future. One of the things, because we've worked with entrepreneurs for so many years, we found that they like to be flexible for changing needs and changing goals, especially if you're a little bit younger. When we say younger, is people in their 60s even, 50s and 60s doing major gifting. Flexibility is the key. We say it's the ultimate asset. And whenever we're moving assets out of the taxable estate, the IRS would like to, as much as they can, try to tax all of our assets ultimately. And so the whole game is designing trusts that keep the control out of the taxable estate's hands so that anything in that trust won't be taxed for multiple generations. So there's a lot around, IRS Section 2036 is all about how the IRS can argue that assets that maybe you said were given away really weren't. So that's the whole game here, if you will. Um, and so importantly, kind of the basics need to be followed when we're moving assets. And then from a flexibility perspective, if you look at kind of the top states, jurisdictions for setting up asset or setting up irrevocable trusts, you'll get 5 or 6 states that are generally deemed to be the most flexible, the best. We do a lot of trust work in Nevada and South Dakota, and South Dakota has perpetual trusts. There's no law against perpetuities, meaning those trusts can go on for multiple generations. They can also be easily moved to other jurisdictions, by the way, from that state. We also do a lot in Nevada. They don't have a law against perpetuities, but trusts in Nevada can continue for 365 years. One of the reasons we like both of those states is because of the asset protection laws. They're proven. The flexibility of directed trusts allow a lot of control, a lot of changes for changing circumstances. If you move $20 million of your assets out of your taxable estate at age 55 or 60, and you maybe have a combined life expectancy of 35 years, a lot could happen down the road. Our clients want to give assets, but they want to understand the flexibility down the road to change beneficiaries, to divert assets to charities, to change the terms of the trust. And the directed trust statutes in those states really allow the most flexibility for long-term assets in trust. So we've hit on a number of ideas here. I know this is kind of high level, big picture. If you're ready to build a strategy tailored to your goals around uh, lowering taxes, reducing risks, preserving, growing your wealth over multiple generations, let us know. Book a call with us. You can email gunner@impactwealth.com. You can call us at 303-645-4800. And do we have any questions popping up? No. So we really appreciate the opportunity to share, folks. We're doing a lot of exciting things. Look out for our webinar series. Dates will be announced here probably towards the end of the year. We're planning on doing a series of 6 webinars, continuing these into the year webinars. But reach out to us, let us know. In general, we would do a quick 15-20 minute introductory call, find out if it's something you all are interested in doing, and then we'd set either an in-person meeting here in Boulder or a Zoom call to dive into finding out if we can help you the way we've been helping families for 30+ years. So with that, I thank you all. Thanks for your time. Hopefully we don't blow away here in Boulder, Colorado today. Let us know if you have questions, if you want to chat about anything, and have a Merry Christmas. Appreciate you.